Hi everyone, I'm Maggie McGrath, the editor of Forbes Women, and today we are joined by Renata Quintini. She is the co-founder and managing director of Renegade Partners. It's a venture capital firm, and they have some news that they're sharing with us today. Renata, thank you so much for coming to our studio.
Thanks for having me, Maggie.
Let's dive right in. We'll get to your entrepreneurial journey, but you have news that you are announcing through Renegade. What is this news?
I'm very thrilled to share that we just closed our second fund at $128 million to back technology companies, mostly at Series A.
And this brings your total AUM to $228 million.
Right.
You have a co-founder, so you are a women-founded, women-owned firm.
That's correct.
Talk to me about the environment you found while raising this fund. There are a lot of reports about how difficult 2023 was for founders of startups and founders of venture capital firms alike.
Yeah. So I mean, we're raising our second fund. Actually, Fund 1, we were very lucky that we have a lot of institutional LPs, endowments, foundations, Ivy Leagues, things like that. So we thought, okay, these are long-term investors, and that's going to make our fundraising for Fund 2 easier. But then with the market environment where we really had the economy slow down, public market, multiple readjustments, a lot of LPs actually were not that hot on venture. And either they already were in the asset class and they already all of a sudden had already too much of it, or the folks that were thinking about getting in, they're a lot more skeptical because nobody knew what the bottom was, what prices were going to be. So people were more in the watch and see mode. So it took a little bit longer than we thought it was going to when we first started. But we brought in 6 new LPs to the fund, foundation, pension funds, really high quality folks that we're very happy to have as part of our LP base. So,
how did you navigate that market environment? You mentioned the hesitancy that certain LPs had. What was your talking point, or what was the point of persuasion that you found most effective?
I think that LPs learned that, so the last financial crisis in 2008, a lot of LPs decided to pull back out of venture completely. And they learned that you shouldn't do that, because it turns out that 2009, 2010, 2011, those were fantastic vintages, and they ended up missing out. So I think some LPs decided to readjust and said, okay, maybe I'm going to write smaller checks, or I'm going to go a little slower. So I think they learned to not step out. And then the second was really the power of emerging managers as the next crop of venture. Because if you actually look at how the ecosystem has evolved, a lot of the firms that have been in business for a very long time, they have grown AUM, and they become a little bit more multi-stage in nature. So emerging managers are really coming into the fold with new products, focus more on founders or more boutique approaches, and those can be great generators of returns in the future. So those were like the 2 talking points that were very powerful.
That's really interesting about the vintages. So
yes.
Is your prediction for 2024 and 2025?
Oh, we're very excited. We're very excited to have dry powder, and we see the quality of founders, the quality of companies. I think companies are building better, right? 2021, it was a lot of money in the system, and with a lot of capital, sometimes you build a little bit more inefficiently. So founders learn how to do more with less, and they're building just better quality businesses on top of just great products.
So let's talk about Fund 2. Your
Yes.
Series A, you're looking for newer startups, if you will, earlier stage startups. What exactly are you looking for in this fund?
Yeah, so for us, I think there are 2 key words. I think one is markets that matter. We're really looking for industries that are ready to be disrupted, industries that are important to the economy. So for example, in Fund 1, we led the Series A of a company called Airspace Intelligence that is using AI to better optimize and simulate everything that flies, starting to sell to commercial airlines and then move later to defense. Those are very critical markets. If you actually look at the amount of the value of assets that are flying and being deployed in the sky all the time, and it's a very valuable piece of the economy. And actually, when we led that Series A, it was during COVID. Not all the planes were flying, but we knew that that was an essential industry to the world's economy. And when it came back, it was going to come back with more efficiency and more intelligence. So we felt really comfortable making that investment. So one is that idea of markets that matter, and transportation, global transportation is one of those. And then the other one is durable business models. So we're really looking for companies that can go the distance as businesses. They're really building most important products for their customers that are really part of the most important workflows because they have better revenues, they have better expansion possibilities, and they're just more resilient when things don't go as planned, especially in the macro environment.
Interesting. Now, I've seen you described as a futurist, and you kind of have alluded to technology of the future in what you've just said. What are some themes you're seeing from the companies that you are talking to? Maybe not investing in. I'm sure you talk to a number of founders. What are you noticing as the technical trends that are happening either within aerospace or within the tech sector as a whole?
Yeah, so I think one story that we very much continue to see is this idea of how can we get legacy, very important industries, but that are sitting on decades-old technology, and how can we bring in best-in-class software, analytics, and intelligence to just better use assets and optimize decisions, right? So aerospace intelligence is one of those examples. We just led the investment in a company called ANSA that is doing a closed-loop wallet technology that is basically reinventing payments infrastructure and allowing merchants to create loyalty for their users, but without having to pay large processing fees. And it's actually like a big undertaking on the rails and payment APIs, right? So that is sort of reinventing legacy infrastructure there as well. And then now with AI everywhere and everything, we're actually kind of seeing, before it was software as a service, and now we're seeing a trend of service as software, which is really interesting to watch.
What does service as software mean?
Because we're seeing a lot of these vertical applications that are giving humans superhuman ability. Selling to lawyers, selling to accountants, selling to whatever it is your daily workflow in your job, the technology is making you do a better job at it. So before it was, let me sell you software so you can do your work, but now the software is actually bringing in intelligence. It's bringing in insights. It's saying, okay, I can help you figure out what a customer is wanting if you're doing customer service, for example. And these are the trends, so this is how you actually serve this customer better. So like this idea of how AI is flipping service in its head is very interesting.
So does that mean you are bullish on AI as an investor?
Long term, yes. Short term, very cautious. So I think, as a consumer, the amount of evolution that AI has had in less than 2 years from a technology perspective is astounding. And also the amount of really great founders that are building interesting things is unparalleled, and the amount of capital actually providing. So like it's a great environment to create things. But when we think about, as investors, what is going to create durable long-term value, we think one is probably going to lie more in the application layer. Like we're seeing a lot of great stuff being done in models, but the incumbents like Facebook, Google, et cetera, they're spending a lot of capital, and they have a really great position to own that. So as a net new investor, that's not a space that we're looking to invest in because it's very well capitalized, and the incumbents are doing a great job promoting innovation. So then we kind of move to the application layer. What will users be doing with it? Applications and interfaces. And in that one is very competitive. A lot of people kind of having similar ideas at the same time. So it's not that rare to see one company be a first mover, but very quickly you have 3 or 4 kind of fast following. And then the second is, what will be the durable advantage that company will have, right? Because in the end of the day, if you have better data, you're going to win. And it's very unclear to us at this point with these companies that are starting, how are they better advantaged compared to incumbents in the space in terms of having new data, et cetera. So we're watching to see really where durable advantage remains. But we're seeing our portfolio companies use AI. All of them are using AI either as ways to improve their own efficiency and their own margins, or as part of their roadmap on new products that they're creating or they're already offering so that their customers can use their tools better.
What do you think is the most common misconception about AI right now? And I ask because as you're talking about AI being used to build durable businesses and find true efficiency, there's a real value proposition there. But I was in a conversation the other day where it was a group conversation, and someone was one person mentioned AI and someone's like, God, it's everywhere. And just kind of a little sick of the subject. And these weren't weren't investors, mind you, but I'm wondering, is there something that is getting lost in translation between Silicon Valley and the general public when it comes to how AI is developing?
Possibly, but I think the exciting thing is AI is everywhere, and that is what the most valuable thing is going to be about it, right? Because if you think about the last time it happened, it was SaaS. And when it started, it was all on-prem, and you have, sort of Mark Benioff coming, and the no software behind him, and look where we are, right? Everything is SaaS. Like today, if you see a company pitching, I am a SaaS company, of course you are. Every company sort of is. And we really believe the same thing will happen with AI at some point, and is actually happening pretty fast. I think where things may be getting lost in translation, I think one is the excitement for the technology and true use cases being equaled to immediate value creation for investors or even for users, right? We see models getting better all the time, but they still hallucinate. They still sometimes will give you results that are not that great, that you may feel like, okay, I'm wasting my time trying to do this here. Wasn't this supposed to be amazing and fix everything now? So I think the disconnect may be the excitement that technologists and investors may feel now, like, oh my God, isn't this incredible? Because look at how fast and how far it's come in such a short period of time. And all the dollars and, like venture investors are very excited about AI. Some may say too excited at this point in time. But then when you kind of think about the underlying user, what is the true value to me and what is it doing for me? It may not be right where the promise is. Does that make sense?
No, that makes sense. As someone who has had to correct a number of AI transcripts, right? I do a lot of interviews, and then you upload them and AI transcribes it, and some of those words are not what we said. So I have to go in and fix it by hand. But it's certainly better, to your point about how much it's grown, it's certainly better than the days when I had to sit there and transcribe by hand. Well,
and if you also look at, every 6 months there's a new model out there, or somebody else is trying to come up with something new, and it's, able to be done. I mean, just look at what Sora is doing on the video creation. If you look at the output of generative AI on video 17, 18 months ago versus to where it is now, the realism and the details and just the ease of use, because you can prompt it like you prompt a Google search and it just comes out. So give it another 24 months, right? And that will be really, really impressive.
24. So a lot can happen in 24
months.
A
lot can happen. I mean, yes, a lot happened in AI in 24 months, and give it another 24 months, it will be a whole new world.
And you launched Renegade more than 24 months ago, but not that much more. When you launched in the height of COVID?
Yeah, so our first close was Friday, March 13th, the eve of COVID.
Oh, God.
Yeah, the Princess Cruise was literally coming into the bay. People were buying provisions for shelter in place, and we're on the phone, hey, are you going to send the paperwork so we can have the first closing or not? So it was a Indiana Jones kind of, hat down the
what a time to launch a fund. And you had been a general partner at other funds before.
Right.
What made you want to take the jump from working for a fund to running your own?
Yeah. So it was really it was the right time in my career, right? So I've been in venture now for 16 years. So this is my second financial crisis as a venture investor. So I have the experience, I had the track record, I had something to bring and a perspective to bring, but I also had runway in the tank in terms of, okay, I have 20 more years to give to start a new firm. The other one, and I think probably the most important one, was my co-founder. I would never have done this by myself. My co-founder and I were friends and collaborators for 13 years now, but then it was her kind of going through the same journey herself of experience, etc. And by accident, actually, we were at a dinner and somebody asked at the end of it, what would you do if you had your own venture firm? And we were completing each other's sentences in perspectives that not a lot of people shared. And then we looked at each other like, oh, we should have this conversation type of thing. Yeah, it was very left field, but not.
Interesting.
Yeah, and so it was the right time. And then the both of us actually spent months. So I was at Lux Capital, and she was at IVP. Like we loved our jobs, we loved our firms, we did not have to leave. So then the bar was really high, and we really wanted to answer two questions. One is, how are we as co-founders, right? Because we know in early stage startups, co-founder risk is like the biggest one. To know, are you a great investor, that's pretty easy. You just share track record, you can get that done right in 10 minutes.
Right.
But this idea of, are you a great co-founder, to me, because it is a professional marriage. So we actually worked with a coach for a few months. We call it marriage counseling before quitting our jobs.
That is so smart.
Yeah.
We've talked about that at various Forbes summits about how important that relationship is. And there are some co-founders who don't start with a coach, but then they reach an inflection point and then they realize we need some relationship counseling. And it's the underlying relationship that can really affect the business.
Everything. And I mean, the amount of things that didn't go as planned, right? We did not anticipate COVID. Who did? We did not anticipate COVID. We did not anticipate the market pullback in 2022, like two banking crisis, right? We didn't anticipate any of it. And because we had done the work with the coach, Roseanne and I never had a disagreement. Like we get on the same page in a matter of seconds, and then it's all about moving forward because we have so much alignment on what's important for the firm, how we handle things, what are the priorities. So it makes us so much more efficient and on the same page. So that was number one, are we good co-founders to each other? And then the other question was, does the world need another venture capital firm? Because we're in this to win. Like we really want to build the next top decile venture firm. And we wouldn't have started this if we didn't think we could. And the whole premise was, why should the world care? So I actually started my career as a LP investor in venture funds for the Stanford Endowment when venture was transforming. So that's when Andreessen was getting started, Felice's first round, all those guys. And I raised my hand and I said, hey, we don't have any exposure here. Can I go spend time? So I ended up building the emerging manager portfolio for Stanford in venture back in the day. And I had to answer the same question to my colleagues, like, why does the world need another venture capital firm? And the insight that I had back then was, if founders are going through a new journey, they have something that's top of mind for them that is beyond just money and brand. Because everything equal, and venture in particular, brand always wins. And back 15 years ago was with the whole idea of the 10x cheaper to start. Right, you had global distribution channels, mobile, cloud computing platforms, so you could actually start a company with $500,000. So then all of a sudden, product market fit, meaning what do I build, what do I sell, as a discipline changed. So that's when YC got started. Like so many things got changed. It was easier to start, but it was more competitive. So if you actually go to the early days of all these firms, they had something that would help founders either accelerate their product or their revenue. So they brought something new that founders care about in the time they care about. So then Roseanne and I were thinking about it and said, okay, what has changed for technology companies in the past, 15 years or so? And what we saw was the need to build bigger and better teams started a lot earlier, because now Fortune 100 buys from startups. Your markets are truly global. If you have something that people want, you got to go build it, you got to go sell it, and you got to service it. And people will not give you a pass if you're a Series A startup. So it's not uncommon that we were seeing Series A startups with 40 people.
Wow.
On a few $1 million raised, or sometimes 20, 25, 30. It's not uncommon anymore to see companies that look more like more grown-up businesses. So we know, because we've been on the boards of many category-defining companies, and we saw that the difference between those that made it and those that didn't were the ones that could figure out how to really scale their people, how to really scale their operations to continue to seize on the momentum that they were creating.
That sounds so simple, but given all the layoffs we've seen in the last year, proves that simple is not always easy.
Well, we talk about its execution, and who executes is people, right? And it's, let's even put aside the 2021 oversupply of capital and what that created, right? Like, it's not uncommon to have a startup that has, let's say, 15 people. They find product market fit. They raise, $10 million, And, you know, they start servicing their customers, and it's not uncommon for them to maybe hire 20 people in a year. That's normal. That means that they are hiring and onboarding somebody every other week in a year. Right? When you think about that, that sounds like a lot. So imagine creating the talent pipeline. What's the process? How do I onboard them? How do I make them successful? How do I train? Or people that have never been managers before. Like, there's actually a lot that goes in that. And then the processes, because now you have to coordinate 30 people instead of coordinating 15 people. Right? There's a lot that goes in execution. And, you know, more people, more problems type of thing. Sounds familiar, right? And founders care about that. So then we really wanted to focus on helping founders through that moment. You know, how can you reduce unforced errors? How can you learn from others so you can continue to run faster? And a lot of founders either haven't done it before, so they know their markets really well, they know their customers really well, but hey, I've never built a company before. Right. Or they have, and they know, oh my God, that's when the rubber meets the road, and I wish I had met you my prior company type of thing. So essentially, in starting Renegade, you asked two questions, one of which was, how do I work with my co-founder? And number two is, what value do I provide to the founders of the current ecosystem? So for folks watching who think they might want to start their own firm, are those the two questions they should start with? And then, and then the third is fund size, and what is your sort of portfolio construction, or how does your math work?
And I've heard you refer to Renegade as kind of a Goldilocks fund size, or at least the second fund is a Goldilocks fund size. What does that mean?
So fund size is actually a really important concept. So I actually started my career early at Felices Ventures, and it was like the beginning of a bad joke. A Brazilian, a Turkish, and Indian enter a bar. That was the three of us in the early days of Felices, starting a new brand. And we had to ask ourselves this question, okay, in the world where brand matters, why will the best founders pick us? And we would talk to other people that were investing for a long time, and they would come and say, oh, you gotta, own at least 10%, or you gotta write, they had all sorts of rules. And then we kind of took the step back and said, the one rule you don't break in venture is the power law, meaning can this investment return my fund? Other than that, I want to partner with the best founders and the best companies, right? I'd much rather own a bite of a watermelon than the whole grape, right? So let's sort of optimize for opportunities to say yes to great founders and great companies. So when we were thinking about Renegade, we actually said, okay, what are the things that we want to be able to do? So one is we want to be able to be catalysts, meaning we have conviction in the company, we have conviction in the founder, we don't need to hear anybody else, we can write a term sheet. We can make a round happen. So the ability to lead was important, but then we didn't want to be constrained by, I need to own 20% of everything I do, because then you're actually working, or you're saying more no than yes. So we actually thought a lot about, okay, what is the fund size that allows us to lead and catalyze, but it gives us flexibility in check size that we say, founder, what is more important to you? What is your company optimizing for? So we can also participate. Or we can take a smaller ownership to bring others around the syndicate to make the company better. If you're managing $1 billion, you can't. The math works against you, and ownership absolutely matters. There are a lot of rules that you have to follow just because of fund math. But at our fund size, at 128 million, we can write first checks up to $10 million. We can lead rounds. We don't have to. And, in some cases, we can participate, have a single-digit percentage ownership that makes sense for our fund math, because what we're thinking is, if this company does what's supposed to do, does that return my fund on a cash-on-cash basis? If the answer is yes, great. Then it's like, okay, how can I get as much as I can? Right. But it's just more opportunities to partner with great founders.
Interesting. I'd never heard that, owning a bite of the watermelon versus the whole grape. But that's a really good analogy for, I think, a lot of aspects of business, not just venture. You earlier alluded to financial crises, banking failures. It's been a turbulent few years. For folks who are watching this and who feel economic or financial uncertainty in this moment, maybe they're a founder, maybe they're an investor at a VC firm, maybe they're neither, and they're just a concerned consumer. What is your message to them, and what is your outlook for the next 12 months economically?
Yeah. I think first is focus on the things you can control, and the value of optionality is huge. For founders, optionality means time and runway. So, probably your investors came and said, trim as much as you can and continue to control your destiny as much as you can. That's coming from a place of give you time and give you more optionality. And then the other one is focus on true customer need, because true customer need equals revenue, right? So you also need, it's not just surviving, you need to also thrive. So continue to hone in on customer need and things that get you revenue. And then on an investor perspective, on one side, the stock market is doing well. I actually find it a little bit hard to reconcile, honestly, because yes, consumer spending is still happening, but federal debt is very high. There's a lot of instability geopolitically. So I'm very cautious about prospects. Who knows what's going to happen with the election, and interest rates continue to be high. I think so two things that I watch all the time. One is, what are interest rates doing? Lower interest rates are much better for our industry. There's just more capital flowing. Buyers buy more. Venture LPs flocking to venture a little bit more as well. And then the other one is when the liquidity window is going to open again, because that was another factor that really hindered investments in venture funds, because usually there's a natural flow of, hey, I give funds money, but I'm getting funds back from distributions and liquidity events,
right?
And the window has been closed. So once capital starts flowing back,
yeah, those liquidity events.
Yes.
I have too many statistics in my mind right now, but I think broadly speaking, 2023 was not great for that. Will it be better this year, do you think?
I hope so. I hope so.
Any other predictions? You're sitting with dry powder. You're looking at aerospace and AI and the technology sector as a whole. Any final predictions?
Yeah. I think really kind of go, like we say, markets that matter. Like these are the things that are always valuable and are always resilient. So, we started investing our Fund 1 in 2020. 2021 happened, the velocity in the industry picked up, right? Like funds that used to be deployed in 24 months, they were deployed in 16. People were coming back to market really, really quickly. And we said, you know what? Let's actually take time. There's this concept called time diversification, meaning they are exposed to different years and different market conditions that if you're kind of, picking a moment that's off, you have time to average down. So we actually invested Fund 1 over 3 years, which was very uncommon, and we felt very unhip in 2021 when people were like, what are you doing that you're so slow? Why? How come you're not raising Fund 2 already? And we saw a lot of our peers actually doing it because we didn't know if what was happening in 2021 was truly a systemic change or just a point in time. And so we said, okay, then let's also back businesses that are durable, right? Things that need to exist in markets that need to exist, basically. And then as a result, 70% of our Fund 1 companies have over 3 years of runway. And 80% of our companies in Fund 1 that were eligible to raise a follow-on round did so. Very early in our lives, I'm not, claiming victory, but that just shows that these are assets that need to exist. Businesses that are providing something for their customers, that are seeing revenues expand because customers are buying new things that they sell, right? That they're not seeing a lot of churn, and that's a great leading indicator. So don't follow hype. Focus on customer need.
Don't follow hype. I think those are excellent words to end on. Renata Quintini, thank you so much for joining us.
My pleasure. Thank you for having me.